Doug, it seems like, in a way, this One Medical attempted buy affirms what you're saying, because $18 a share looks pretty good based on where it was trading yesterday, but it was trading much, much higher than that before, and that's a public company. Private companies still haven't entirely had that full rationalization, have they?
They really haven't, and I think Klarna a few months ago that really was the first example of a company that has had that rationalization. We've been calling it kind of the return to sanity, where 2021 was very much a seller's market to the extreme. And I think when you get sellers markets to the extremes, you end up in bubbles. And now investors are sort of coming to their senses. They're saying, look, we actually have to buy assets, not just on quality of business and pay anything, but we need to buy assets that eventually can justify the price we're paying based on future performance. That's sort of investing 101. And now that the bubble, I think, has burst, we're sort of returning to that mindset. So
why should retail investors in the public markets care about this? And I think there's a bit of IPO market in here. There's a bit of perhaps acquisition questions in here as far as what's going to be truly affordable for public companies to buy to fuel growth.
I think you have to care about it because no matter how great a company is, if you pay too much for it, your returns will end up being disappointing. And so for us, it all comes back to kind of thinking about the odds of looking at a valuation. When you look at a valuation, it is really that demand on future performance. And given, let's say, a return expectation of 15 or 20%, something like that is probably what a lot of growth investors really want to target. If you have that kind of demand for returns, you can roughly calculate what revenue and earnings have to do and then say, well, how likely is that to happen? And when you're seeing things that feel very unlikely to happen, you should be sane, even if it's a very high quality company, and try to avoid those and err more toward quality companies where they are pricing in things that you think have a good chance of actually happening.
So, Doug, look into your crystal ball, if you will, for us, and predict how what you're seeing in the market could impact the M&A landscape, especially in terms of acquisitions of private companies. I mean, we've been talking this morning so much about Amazon's acquisition of a public health tech company, but what do you anticipate in terms of M&A going forward, or even how the VC market might change, considering these changes you're talking about?
I'll start with the VC side. I think that by and large, we've seen a pretty severe slowdown in VC activity. It's probably not surprising to hear that. I've heard of a few funds that have actually just paused investing entirely. And a lot of the funds that we talk to that say they're still looking at deals, they're probably more closer to pause than they are actually trying to be aggressive and deploying right now. So VC, I think, has had a slowdown. I think we will eventually see VC return to somewhat more normal activity now that the markets are reflecting what happened in the public markets, maybe over the next 6 to 12 months. On the M&A side, I think we have seen some activity. Thoma Bravo has been very active on the PE front. They bought a few companies. Obviously, we've seen Amazon be aggressive today with their acquisition. And so I think there are some companies, if you really go and you dig into the numbers and you get comfortable with the fundamentals and what they have to kind of do in the future, there probably are some companies worth buying. But I think there's probably more landmines out there than there are absolute bargains, despite the fact that so many high growth tech stocks are down 70 to 90%.